iShares Core Dividend Growth ETF DGRO is a low-cost, large-cap U.S. equity ETF that screens for companies with a history of growing dividends. It holds approximately 390 to 405 stocks, with top weights in Apple, Microsoft, Johnson & Johnson, JP Morgan, and ExxonMobil. Expense ratio is very competitive at 0.08%. Total assets are large, about 34 billion plus, and the trailing yield sits around approximately 2%, varies with market. Performance context. DGRO has delivered strong multi-year returns, roughly low to mid double digits annualized over recent 3 to 5 year windows, outpacing many plain value peers while blending growth characteristics thanks to its dividend growth screen. Past returns aren't a guarantee, but they show resilience through market cycles. 5-year outlook. Upside drivers. Dividend growth engine. Companies that consistently raise payouts can compound income and support total return even in muted price gains. Large cap quality bias. Heavy tech plus financials exposure can continue to lift returns if earnings remain strong. Low cost and diversification. Low fees and approximately 400 holdings reduce single stock risk for buy and hold investors. Risks, headwinds, interest rate sensitivity. Dividend-focused strategies can underperform if rates rise materially and bond yields become more attractive. Sector concentration. Tech has grown in the top weights. A tech sell-off could pressure DGRO despite dividend focus. Slower dividend growth macro. If corporate earnings stagnate, dividend increases may slow, limiting DGRO's advantage. What Wall Street/commentators say, analysts and ETF commentators broadly view DGRO as a solid core dividend growth ETF, attractive for investors wanting a blend of income and growth at low cost. Some outlets rate it a hold or compare it favorably to peers, VIG, SCHD, VYM for consistency and fees, while noting it's not the highest yield, it's income plus growth, not yield maximization. Experts recommend DGRO for long-term portfolios that want dividend growth exposure without concentrated high-yield risk. Bottom line, DGRO is a low-cost, diversified way to own dividend-growing U.S. large caps. Over the next 5 years, expect modest total returns driven by earnings and dividend growth, not sky-high yields. It's a sensible core holding if you want income that can grow, but be mindful of rate and sector risks. Not financial advice, do your own research.